big investors are hiding their cash. Should we be doing the same thing? Okay, let's explore. I found this article here. It says investors are hiding out in cash, putting 20.4% aside as volatility erupts. So, yeah, so there are a lot of institutional investors, which are the big, you know, the guys that manage all the mutual funds and all this other big stuff. They're putting more and more cash aside, right? Because they, don't know what's going to happen. Because right lately, cash has been king. Because the stock market, if you've been paying attention to the stock market, it's been kind of doing this sort of thing, or even going down, right? Um, and same with bonds. Bonds has been kind of very volatile. They've been selling off a lot of bonds because interest rates are going up. As you can see here, it says long-term institutional investors kept more of their portfolios in cash in September as volatility struck roughly $25 trillion treasury market, spurring a sharp sell-off in stocks and bonds, according to State Street. Okay, so normally, traditionally, I guess they have a 60-40 portfolio construction, which basically puts 60% stocks, 40% bonds. But lately, they've been, threw that book out the window, and now they're doing more of a. It looks like they got 20.4% in cash, 28.5% in bonds, and 51.1% in stocks. Okay. And as you can see, it says it's been stocks have been dropping. Okay, so that means they're pulling their money out of the stock market right now and just hold on to that cash. Um, so it's not a very good sign because that means scared money don't make money, right? And so they're going to be so right now they're scared, right? And so that's very interesting to me. So I I actually came across this video here, which I thought was pretty interesting. So let's take a peek at this. This kind of explains a little more kind of what's going on in the markets. Let's get into it.
Horizon Investments Chief Investment Officer Scott Ladner. Scott, good to see you. Thanks very much for being here. We've been watching the jobs market hold pretty strongly, even in the face of weakness and slowdown elsewhere. What are you expecting from these jobs numbers?
Hey, Maria, and thanks for having me. Look, we're expecting much of the same as we've seen in most of the other employment numbers that we've gotten over the last month or so, which is a continued strong employment picture in the United States. Companies in the U.S. are really resilient to these high rates that the Fed has been imposing on us. Consumers are really resilient to it, and that picture all adds up to a strong labor market, a pretty resilient economy, and numbers that we think are going to kind of come in pretty much on the screws.
Are you expecting a slowdown or a recession in the first half of the year, as some are?
Look, we're in the middle of experiencing a slowdown, Maria. But as far as recession goes, no. This is still an incredibly strong economy. We are in the midst of a productivity boom with respect to AI. We think we have a productivity boom coming in the quantum computing space over the next 3 to 5 years. And the Fed and the economy, aren't intent on killing it if they don't have to. And it looks like we may be able to escape by on this one.
Yeah, some Federal Reserve officials showing really little concern that the increase in yields could imperil that soft landing for the economy. We heard from San Francisco Fed President Mary Daly yesterday. She says the central bank can hold rates where they are if the labor market and inflation continue to cool. But I spoke with Jeffrey Gundlach this week, one of the leading bond investors, and he said if the economy does go into recession, we could see a significant cut by the Federal Reserve next year. Watch this.
Okay, so before we watch that guy, I just kind of want to talk about this guy just said. So I thought it was kind of interesting. So she was asking, okay, a lot of people are predicting there's going to be a recession next year, right? And this guy was saying, yeah, I believe there's going to be a slowdown, but recession, no. And he was claiming, which I thought was very interesting, is that he was claiming AI is responsible. So AI is artificial intelligence, and he says that our productivity is going up. which is a good thing if you're for everybody, right? Because if you're looking at reducing inflation and everything else, usually you want to increase your productivity. And what does that mean? It means you're working smarter, not harder, right? So that means if it took you, if it took 10 employees to do one job, now it only takes one employee to do that job. That makes that one employee very valuable, right? And so an AI is the reason for that. So and that makes our quality of life go up. That makes our incomes go up, and it keeps inflation level. Well, hopefully, right? So it's very interesting. So now, do I think AI is going to save us all or kill us all? I don't know. I mean, that's a whole other conspiracy. You might want to watch my other videos about that. But right now, AI is very promising as far as our pocketbooks, right? So that's something to keep an eye on as far as markets and where maybe to put your money. Because according to the article, it was claiming that, hey, a lot of these guys are putting their money just keeping cash, right? And so there's another guy I wanted to show you, and I thought what he had to say was even more interesting. So let's get into that one.
Does the Fed cut rates next year?
I think they will. I think most of the forecasts for what will happen next year are implausible. There's a lot of forecasts that they'll cut maybe 50, 75. That's a no man's land number for me. I don't think they cut it all if the economy doesn't slow down, if unemployment doesn't go up, if inflation gets a little bit of afterburners because we have oil back up at 90. And things like that, they might not cut it all. But if they cut, it's going to have to be in response to sort of an economic shock, which would be a recession, and maybe that would lead to a cut of 100 basis points as the first cut. That could happen. I think that's more plausible.
That was an incredible prediction that the Fed could cut 100 basis points. What do you think about a cut in rates next year? Obviously, that was one of the drivers of this market rally all year this year.
Yeah, look, I mean, I think Jeff's right. If the first cut is 100 basis points, that means we're in trouble, and that is not something that we see in the cards right now. I mean, this is just not an economy that's showing signs of that kind of weakness that would lead to that kind of rate cut. So right now, the market is pricing in 3 or 4, 2 or 3, 4 basis or cuts next year in a pretty moderate and predictable fashion.
Yeah.
We think that's about right because those are basically neutral cuts. That's the Fed normalizing interest rate policy, not having to remain restrictive because inflation is durably coming down and because the economy is slowing, but not slow so much as to drive us into recession.
Okay, so what this guy said, I thought was pretty interesting because he was thinking that the Fed is going to cut interest rates starting next year by like a half point, maybe 3/4 of a point, something like that. And that would be very good for the economy, as far as like the housing market and stuff like that. But is it good for inflation? I don't think so, so because as he was saying, if inflation is persistent and, our economy does too well next year, like if it's still resilient and, AI is booming and all this other stuff, you might end up with no interest rate cuts. The Federal Reserve, there's some predictions, they might even cut it by a full percentage point. Okay. And if that happens, that would be very bad, right? That would mean our economy is in a recession. We're not doing good at all. And what I see happening if we start cutting interest rates by like a full percentage point and stuff like that, you're going to get some serious inflation, and because anytime they cut interest rates, that usually means they're printing more money, and when they print more money, that just adds to our inflation, and things are just going to spiral out of control, and we might end up losing our reserve currency. You know what I mean? So it's on the national stage, which would be very bad for the U.S. So I hope I hope for the best for our country. I'm thinking that my prediction is they might actually keep interest rates the same because I'm thinking inflation is going to be persistent. If they don't get, I don't see any reason why they should cut interest rates if inflation is persistent. If they do, they're a bunch of idiots, right? Because if you start cutting interest rates and inflation is still high, you're just asking for more problems. But if you can get if you can get inflation down to 2% or something like that, then I can see them cutting back. But if they still have inflation high and they want to juice the economy for let's say elections or something coming this next year, which I could kind of see happening because in previous years the stock market's always gone up prior to an election just because they want to kind of juice the economy to make whoever's in office look good. So it's going to be pretty interesting. What do you guys think? Do you think they're going to cut interest rates? Do you think they're going to keep them the same or maybe even raise them? Comment down below, like, subscribe. Peace out.
Even when you feel low, you can still go. Even when you feel slow, you can still go. Even when there's no hope, you can still go. I never answer to no, man, I still go. Go, go.